Aloha and welcome to Condo Insider, which is on Hawaii, Think Tech Hawaii each week, every Thursday from 3 to 4 p.m. About 1/3 of our population lives in an association, and our show is all about educating board members and owners about their obligations and providing solutions to having a great association. One of the most important parts of an association, in my opinion, is the financial statement. You know, the board is charged with the responsibility of managing the property and managing its money and making sure they make sound business decisions. So today we're briefly going to review association financial statements and the audit that's typically required by law. And we're very lucky to have with us today Rodney Harano, a CPA with CW Associates. Welcome, Rodney.
Good afternoon, Richard. How are you?
Good to see you again.
Thank you. Thanks for having me.
I'd like you to just tell everybody here a little bit about your background and your company's background, what you do, and we'll get it going from there.
Sure. Anyway, our firm is CW Associates CPAs. We were formed in 2008. So actually, the firm has been around for about 20 years. It was founded by Carl Williams, who then created CW Associates in 2008. We currently have 42 people, 5 partners, 5 managers, 3 supervisors, and a whole bunch of associates. We're the 8th largest CPA firm in Hawaii. Sorry about that.
If it's the president, you can take the call. It's not the president.
That's for my medication.
Or a president or a potential nominee. You have to give up the
so anyway,
call.
So we're the 8th largest CPA firm in Hawaii. And as far as for me, I've started doing CPA work back in 1978, so I've been around a long time. I started with the firm of Grant Thornton, and for the last almost 38 years, I've been doing public accounting. I really love being in the profession.
Well, if you're going to be a public accountant, like a CPA, what kind of education or schooling or testing or licensing do you have to become a CPA?
That's a good question. So as far as becoming a CPA, there's we call the 3 E's. First of all, you have to pass the national exam, which is given by the American Institute of CPAs, and that's given throughout the year. The second part is education. The second E is education. So you need at least 120 hours to sit for the exam, and to actually then become a CPA, you need an additional 30 credit hours. So you need a total of 150 hours to be a CPA. And then the third thing is experience. So in Hawaii, there's 2 ways to get experience. You can either work for 2 years in a CPA firm or being supervised by a CPA, or you can get 1,500 hours of audit, 1,500 audit hours. And once you get those 3, then there's some paperwork, but then you become a CPA. Then you can call yourself a CPA.
So once you become a CPA, do people like specialize in certain parts? I mean, are you like a general practitioner, or do people become more involved in certain aspects of accounting and focus their attention on a part of accounting, like audit or forensic audit or financial statements or how does that basically work?
It depends. So like I said, I worked at Grant Thornton when I came out of college, and so I was an auditor. But and then about 5 years into my profession, I actually started my own firm. And then when you start your own firm, oftentimes you have to do everything. So I did payroll, I did tax work, and so I still do a little bit of everything. But like some of my partners, they stayed in, like Carl stayed in audit. I mean, he's done audit for like 40 years, and my other partners are specialized, so they kind of pigeonhole whether they're auditors or tax people. But again, larger firms can specialize. Smaller firms have to do a little of everything, so more of a general practitioner.
Well, I find with associations, there are a bunch of volunteer board members, and granted, we actually have CPAs on some boards, but more times than not, we have the person who maybe has their own personal checking account bookkeeping experience. And so I'd like to focus a little bit about association accounting.
Sure.
And specifically that area, try to answer some questions people may have. The first question is, if you're an association in the state of Hawaii, do you have to have an audit?
All depends on the number of units that the association has. So my understanding of the rule is that if you have less than 20 units, you don't have to be audited, but you have to make an election at the annual meeting not to have the audit. So it has to be by a vote of the membership not to be audited. But if you have more than 20 units, then you're required by law. And I believe the statute is 514B 150 that requires you to have the audit.
And that's my understanding as
Right.
well. And it's a common misunderstanding, I think, in the industry. Certainly, any association with 20 units or more must have an audit by law. And they have to, upon the owner's request, distribute that audit to the owners.
Correct.
If there are less than 20 units, it requires an election by the membership, the owners, to say we waive having an audit. It's not a matter in the law, you just don't have an audit. The members each annual year has to, at their annual meeting, adopt a resolution saying, we waive having an audit this year.
Right, I understand, it's, you have to opt out, it's not just being silent.
Yeah. And in either case, they still have to file their income taxes.
Yes, correct, they do, yes, they still do.
Because that would be a real issue with those units. My understanding also, when you look at an audit, there's different terms. There's like an audit, a compilation, a review.
Right.
What is, in simple terms for the layperson, what is the difference between, quote, the types of audit and?
Okay, from our technical standpoint, again, just 3 levels, and it's level of assurances. So the lowest level of assurance, which there's no assurance, is the compilation. And basically, you're relying on what management provides you, and you're using that information to prepare the financial statements. The next level is what they call a review, and then as a CPA, we are expressing limited assurance on the information that the client is providing us, and we do some smell tests, what I call smell tests, to see if the numbers make sense, and based on the client's industry, if the numbers, the relationships within the numbers make sense. And again, the highest level is an audit. It's not 100% guarantee that the numbers are correct. Again, in an audit, the primary purpose is that you have reasonable assurance that the numbers are fairly stated. And the difference between a compilation, let's say a review and an audit, is in an audit, we use third-party verification, corroboration, and verification to make sure the numbers are accurate. Whereas in a compilation or review, you don't necessarily have to confirm or verify with third parties.
Well, because the statute says the word, quote, audit, I'm assuming that means they have to do the highest standard. They can't do a compilation or
Correct, yes.
review. They actually have to do the more detailed version of looking at the financials and I'm going to call them limited assurances, but they're higher level of insurances than the
Right,
compilation
correct,
and review.
correct.
That they don't have a choice about that. They have to do an audit.
Right.
And those are standards and kind of procedures are governed by the American Institute of Certified Public Accountants?
Correct, yes.
Because the AICPA is the governing body for your industry.
And they're actually the Auditing Standards Board, which is part of the American Institute of CPAs, this body actually promulgates auditing standards.
So if an association has an audit, a legitimate audit by CPA, the odds are pretty good the information they have in front of them has a good chance of being accurate or something you can rely
I
on.
would say reasonably accurate. How's that?
Yeah, reasonably accurate. But because certainly in today's world, people are always worried about theft and misuse of money. And from the auditors I've worked with in the past, I know they would go in and look at the minutes, they'd look at the invoices, look at the checks that are written.
Correct.
They went through and did some tests to make sure it makes some sense with respect to the numbers that appear on the annual financial statement.
Well, there's a thing called materiality, so which is hard to grasp as a layman. And what materiality means is that if you had a $20 million company and there was a $100,000 error, that $100,000 error may not be material to the $20 million. The $100,000 may be material to you and me, but for a $20 million company, the $100,000 may not be material. So it all depends on the size of the entity and what materiality is, because we may find an error that's $5,000, but we may decide not to record it, or we say it's still, the financial statements are reasonably stated, even if it's $5,000 off.
And although we'll get into this a little bit later when we talk about financial statements, my personal experience has been that the most common problem has been that you get the invoice, it's for electrical supplies, and somehow they code it as plumbing supplies. So it's really not an error as far as the bottom line goes.
Right.
It's more of an error as far as tracking expenses and costs. And it's just an unintentional error that, my wife's got a very solid accounting background, and although I think she told me the last time she made a mistake was 1982. But the reality of it is, the truth be told, that people do make unintentional coding mistakes that are adjusted each year when you close out the financial statements and you kind of go and look at that kind of stuff.
Right. So actually, that's what we call reclassification. So really, if it's supposed to be plumbing, but it's coded to AC repair, it doesn't really. We tell the client, okay, it should be here, but again, it's a matter of materiality, and it really doesn't affect what we call the bottom line. So oftentimes, the other thing that's interesting is we group numbers together. So if it's grouped into a larger number, it may not impact the
Right,
overall
yeah.
number, right?
Well, I think audits are good because it protects the owners, and owners get very impassioned about their association, and I think it's important that they understand or know that there are safeguards, checks and balances to make sure that the money is being properly spent. Doesn't mean the board's always making good business judgments on how they spend the money.
That's true.
That's true of business and
Right,
government and everywhere
right.
else too. So, but the reality of it is that I think that's a quality thing. But one of the things I want to get, and I want to come back to the audit a little bit later.
Sure.
One of the things I want to talk about that I find there's a lot of misunderstanding, a lot of discussion about, and that's the types of accounting. And to me, there's the common types are cash and accrual, although there's fund accounting and a whole bunch of other stuff. But for the associations, there's usually a cash basis accounting and accrual basis accounting. And most people misunderstand what the differences are and what the pros and cons of each of them. So let's just discuss both those for a second. Let's talk about cash accounting first, and then we'll do a little bit on accrual accounting to try to explain to our audience what the basic differences are between the two.
Okay, so cash accounting is exactly what it means, cash in, cash out. So you record revenues when you deposit the money, and you record an expense when you write the check. So it's more of a cash flow accounting than what we call accrual accounting. So if you can, so if you receive something today and you deposit it today, it's income today. And if you write a check today, then it's expense today. Accrual basis accounting is a little different than that.
So in some ways, cash basis accounting is kind of like your personal checkbook.
Yes.
You got your paycheck, you deposit it, you make the entry, deposit, check, paycheck. And then I wrote a check for the HECOs, so I wrote a check, and that's kind of the cash balances. But it seems to me in some ways, when I've looked at most associations, more times than not, they do their budget on an accrual basis accounting. They say I have 100 owners paying $200 a month, that's $20,000 a month income, my electric bill is $5,000, that they do that. So there's probably some need for the board to understand the differences. So when they look at their actual financial statement versus the budget, they can be asking intelligent questions with respect to why the numbers might vary.
Yeah, that's a good point. That is because, you're right, most boards create their budget on an accrual basis. Yeah.
And I understand cash accounting. I think there's certainly a place for cash accounting. But when I've actually seen transitions from one management company to another, for example, I would have a board say to me, well, we took in $1 million. We spent $950,000. We have $50,000 left over, and that's after funding the reserves, which is a contribution to reserves. Why are we having a hard time with our financial statements? And it was on a cash basis accounting. And when we looked at it further, because again, as you stated, you're reporting when you paid and when you received. If they had $300,000 of unpaid bills in the drawer, they would have this probably unrealized liability or unrecognized liability when they're looking at that statement. So the association could have cash flow problems even if the financial statement looks like they're having a positive gain.
Well, actually, that's a great example. In reality, the association actually has a loss.
Right.
If you didn't record those unpaid bills as a liability, you've got a $300,000 loss now.
So is this something they should be asking their management company or their treasurer? Do we have any? I don't think there's no balance sheet in the cash flows,
Right.
in cash disbursements. So or cash basis accounting. So how do they kind of protect it? Do they ask their management company or their treasurer, do we have any other outstanding obligations, or how do they kind of identify that?
I think that's a start. I think if you're on the board, you should have a pretty good understanding what bills you should be seeing. So, you're going to have the normal utilities and the recurring expenses. I think that should give you an idea. So if you don't see something on, your financial statement during the month, you should be asking the managing agent, why don't I have these expenses? Because probably they don't have the money to pay the bills.
And we're going to take a very short break right now, but we're having an interesting conversation on cash basis accounting. I have some tougher questions for Rodney here in a second. So let's take a short break. We'll be right back.
Aloha, namaskar, and hello. My name is Anu Hittel, and I host a show, Climate Change Beyond Outrage. In it, we go beyond outrage to look at solutions to climate problems facing people, nations, and the world. Join me every Tuesday at 1 o'clock Hawaii Standard Time. See you then.
Aloha, this is Reg Baker and I am the host of Business in Hawaii. We talk about positive stories of businesses in Hawaii, how they have been successful and how they have overcome some of the obstacles that a lot of us encounter when we try to have a business here. And believe it or not, there are a number of positive stories here and we want to talk to all of you. So we broadcast live every Thursday at 2 o'clock. And it rebroadcasts again on Olelo Channel 54. So I sure hope to see you next time. Please tune in on Thursdays at 2 o'clock. Thank you.
Well, welcome back to Condo Insider. We're here with Rodney Harano, CPA, talking about association accounting and audits and those types of things. And we were talking about before the break, cash basis accounting, which in summary was you're recording as the transaction occurs. So when you receive the income and you deposit in your checking account, that's when it's being reported as income. And when you pay the bill, that's when it's reported as expense. And one of the risks is that if you have a whole drawer full of unpaid bills, you may not know about them and you need to have some kind of issues. Because as I was saying, Rodney, before the break, that the other thing I see is that when you look at an association who normally projects to have 100 owners paying $200 a month, that's $20,000 a month. If you have people who are delinquent or don't pay, then that revenue is short.
Correct.
And then on top of it, if all of a sudden 6 months later from now you collected all that money, you could see a spike in earnings or a profit that particular specific month. Year to date should balance out a little bit, but because of the fact it's somewhat erratic in a way based on when bills are paid. And is that a fair statement?
That is a fair statement. I think that's why. I think it's a good segue to talk about accrual basis accounting, because accrual basis accounting kind of spreads out some of those peaks and valleys in cash flow. The only thing, the thing about accrual accounting is that someone has to be on top of it. They have to make sure that they record revenues when it's earned. And what I mean by that is when the managing agent sends the invoices out to the homeowners, that's when it becomes revenue, not necessarily when you collect the money. Conversely, a bill, an expense is recorded when you receive the invoice from a vendor or supplier, not when you pay it. So it's not a cash flow concept. It's basically trying to match revenues with expenses. So that helps the association manage their cash flow. Actually, it helps them with cash flow.
I'm going to come right back to that thought,
Sure.
but I want to, because when we were talking about this in cash basis accounting, I wanted to give our audience a comment about what I do when I look at financial statements. A simple little test that I do for a board on a financial statement. Number one, if you're looking at an invoice or a financial statement, and you're looking at electricity, and this is the month of May's financial statement, and you see they're paying February or March's electric bill, the probability is that they have unpaid electric bills, and you can look at the dates of what they're paying when it applies to, and whether that's in the same month of the financial statement. It's a very simple test to look at to make sure that, or give you some indication maybe there's an issue that they're not able to pay the electricity on time every month. So in the May financial, you're seeing February's payment for February's bill, not the current bill. So that's a simple test you can always look at, and with respect to kind of giving you a feel whether things are being paid timely, which is an indication whether you have money or not. And that's just kind of my thought on that matter.
Well, you actually had another point earlier that if oftentimes the association is just getting a profit and loss statement, but no balance sheet. So if you have a balance sheet, and hopefully you will see, accounts receivable and accounts payable, that is an indication that they're accrual basis, not cash basis. So that's it.
And I want to talk about the balance sheet, but first,
Yeah.
I'm trying to remember his name. I think it was some Italian in the 5th century invented the double bookkeeping system,
Yes,
you know,
I
the
would-
debits and credits. I should have looked it up before today's show, but some accounting, and I find sometimes boards, when they get the financial statement, instead of looking at the report and saying, this is the budget, this is what we spent, well, why did we spend more? They get more focused in trying to figure out all these debits and credits, which they're not accountants, so they get really confused because for every debit, there's a credit, and you get the balance sheet and the equities and the liability and all this sort of stuff that in my opinion, they ought to spend more time on reading the report and not trying to be an accountant and look at all these general ledgers and general journals and all this other stuff and getting themselves confused, you know, because you'll see the same entry maybe 4 times because of the transaction and the nature of it under accrual accounting, you know.
But I agree. In fact, if the board is fortunate enough to have either a person with a finance background or an accounting background, that's a positive because then they can understand the reports.
Yes. Well, let's talk about the balance sheet.
Sure.
What is basically the balance sheet? What does this show?
The balance sheet is a snapshot of the association's assets and liabilities as of a given date. And oftentimes it's usually at the end of the year, or at the end of a month. So let's see, today is May 12th. So the last balance sheet that an association may have gotten was April 30. And that should have your assets such as cash, maybe some fixed assets, and obviously if it's accrual basis, accounts receivable. That's the assets. And conversely, on the liability side, you'd have any accounts payables, again, anything that they owe for outstanding invoices. And then the last part of the puzzle is what we call equity or net worth. And in most cases, it'd be fund balance for associations. That's the leftover. It's really an equation of assets minus liabilities equals fund balance.
Or in some ways, I hate to use the word profits, but it's kind of like the surplus
Right.
cash flow,
Yes.
and the accumulated be for all the years since the beginning of time when you started the project or the association.
Correct.
You know, I've often, you know, I do a little bit of seminar teaching for our industry, and I've always said the simple words I like to use for a balance sheet: it's what you owe and what you own.
Oh, that's really good. I like
You know,
that.
yeah, so it gives you all the things you own, you know, accounts receivable, people owe you money, some fixed assets maybe, prepaid insurance. What you owe is unpaid taxes and/or vendor invoices. And of course, again, the difference would be the surplus or deficit from operations. And that's basically back to the financial statement, which I kind of call the report card, how you're doing against the budget.
Right.
And that's really will drive your success at the end of the day because unfortunately or fortunately in association world, we do zero-based budgeting.
Mm-hmm.
That means you figure it all out, how much we need to pay for all the operating costs, under a reserve study, how much money do I need to save for the future roof, and that at the end, there's no profit, it's zero.
Right.
And so if you're wrong, you're gonna have cash flow issues, and we've seen that in the past when electricity costs went through the roof and they couldn't fund their reserves and the various things that happen in an economic cycle. But I look at the financial statements report card, and what you own and what you owe is the balance sheet, and that's kind of how I've always looked at it. So looking at that balance sheet again for a second. So accounts receivable, because you've billed the owner on the first of the month, whether he's paid you or not, on the first of the month, he owes you that money.
Correct.
And that will go down as people pay you between that and the grace period or whenever they get paid. So probably a board should look at accounts receivable and say, how much money is owed to me? Because from a profit and loss point of view, you're taking the income in whether they paid you or not.
Right.
So if you have income and it shows, for example, under accrual accounting, a profit or a surplus, the truth is, if you have a large accounts receivable, not everybody paid you that money, you still could have deficit cash flow.
Oh, yes, you could, yes.
You know?
So one of the things that, when you look at the end of the month, hopefully the association gets a report called an aging report, and that tells you, a list of all the owners and whether they're current or 30 days out or 60 days out, because the further out that balance goes, the chances of the association collecting that money get less and less.
That's true.
Yes.
And the other emphasis would be because it's a zero-based budget. If they have people not paying them, that means they're not paying somebody else probably, or they're not funding their reserves.
Correct.
Because we've always suggested, or the industry has suggested, that you have a vigilant collection policy with owners, because as a board, you have a fiduciary obligation to protect everybody. And granted, you may have someone with a personal problem and you can enter into a payment plan and in the Aloha way help them. But at the end of the day, you've got to manage that accounts receivable. Otherwise, you're not going to have enough money to pay your bills or fund your reserves.
Right, because actually managing your receivables is managing your cash flow, your future cash flow.
Right. And conversely, on the liability side, accounts payable, if all of a sudden you saw under accrual accounting, you saw that you owed $200,000 of unpaid accounts payable, and you're a small association, it would probably tell you that you have a problem.
Yes, you do.
Because you probably are not paying your bills, and at some point in time, you're going to have that as an issue.
And oftentimes, if you have a large payable balance, you may have a larger receivable balance because you aren't collecting the funds to pay the bills.
And do you have any, and this is kind of a technical accounting question, is you see, I've looked at our state law where you have to fund your reserves and you have to do a reserve study, and I have a lot of experience in that, and I'm not going to get into the technical side of the types of reserve studies. So let's just say we do a reserve study, it says we're supposed to put $10,000 a month into reserves. Well, in essence, you're not really spending that $10,000. It's really like accumulated. It's for a future capital expense. It's not really, you're saving it on the balance sheet, so your reserve fund is growing on the balance sheet. Is there a typical way that's recorded on the financial statement, that the reserve contributions, is it recorded as just a balance sheet entry and growing, or is it typically listed as an expense item, allowance for future capital expenses? Is there any uniform method about that, or is it just kind of varies?
I think it varies, but I know most of the financial statements that we prepare, there's usually two columns in the profit and loss. There's an operating fund and there's a capital fund, and usually you account for the ins and outs between the two funds in the two columns. As far as the balance sheet, as far as keeping track of the cash that's in the reserve, we have a separate line item for the reserve, and that's kind of your rainy day fund, and you don't touch that money. Usually, most times, money's going into the fund as opposed to coming out of the fund. So.
Yeah, as a general rule, we've always advocated that the association have one operating account.
Right.
Everything flow through the operating account. So as you decide to make investments which are restricted by law, they have to be principal protected, for lack of a better word, that you pay those or make those investments from the operating account. You don't pay bills directly from the reserve fund. If you are going to take your reserve fund, you would cash in that financial instrument, put it in your checking account, and pay the bills, because in some ways it gives you a better control and audit of what's going on. And I don't know if that's industry standards or whatever, but that seems to be what most of us, or what we think people should be doing anyway.
Well, that's best practices. So again, you have a better cash flow and a better paper trail of actually the funds going in and out of which accounts. That's really a best practices.
Yeah, because one of my personal pet peeves in all this thing is that owners get confused sometimes about the reserve and the operating expenses. And so we've always suggested that when you do a budget or a financial statement, that you have a separate line item for the, quote, maintenance fee income and the reserve contribution income. So owners can see that a certain amount of money specifically is being saved for that future roof, in the example I gave. And at the same time, on the expense side of it, you separate your capital expenses from your operating expenses. Because if you start doing averages for a budget next year, you could become confused because you have a 20-year roof in there for $1 million, and it destroys the averages for building repairs, for example. It's probably better to try to separate the capital expenses from your regular operating expenses, so you have some better document for planning purposes.
Yeah, I think that's, again, a best practice, and that's kind of industry standard right now.
Oh, good. I didn't know it was industry standard, but I'm glad to know that. So, are you in agreement then that boards really should focus more on the reports themselves and what they say versus the debits and the credits?
I agree with that.
You know,
They should, as most boards should, create policy and let management deal with the debits and credits.
okay, we're going to take another short break and talk about the audit in a few minutes, but this is very interesting about associations' responsibilities with respect to the types of financial statements, and we'll be right back with Rodney.
Hi, I'm Jay Fidel. I'm the host of the SOEST Hour, which is on Monday from 1 to 2 p.m. every Monday. SOAS stands, of course, for the School of Ocean and Earth Science and Technology at UH Manoa. We talk to faculty there, we talk to researchers there, we talk to students and graduate students there, and we talk to people who are related in one way or the other scientifically to that school. Check us out, 1 to 2 p.m. every Monday. I'm Jay Fidel. I'll see you there. Aloha.
You're watching Think Tech Hawaii, citizen journalism from Hawaii, finding the intersection of our sense of place and our place in the world, right here at home. Great content for Hawaii from Think Tech.
Aloha! How you doing? It's me, Angus McTech, wishing you to welcome and join us to see us on Hibachi Talk on Think Tech Hawaii. Join my co-hosts, Gordo the Tech Czar and Andrew the Security Guy, every Friday from 1300 to 1345. We look forward to seeing you. We'll talk tech and we'll have some wee bit of fun. And remember, let your wing gang free wherever you be. Aloha!
Again, welcome back to Condo Insider. We're talking to Rodney Harano about the different types of financial statements, cash basis and accrual basis accounting. I think it's important that boards understand what method of accounting you're using and know the areas that they can specifically look at to help do, I'm going to call it a mini audit for lack of a better word. When I was on the board of the thing I always used to look at every single month was the check register. Because it's pretty hard to know if you try to follow the accounting sometimes. If you look at all the checks issued this month and what they were for, and is that a legitimate purpose, you pretty much know how your money is being spent,
Right.
unless there's something really devious going on, which hopefully people like their home better than OCCC. You know. But let's go back to the audit. Now, we've talked about cash basis accounting, accrual basis accounting. Every year an association has to have an audit. Kind of take us through generally what you do for an audit for an association.
Well, okay, that's a tough question because it's a pretty laborious process, but usually we meet with the association beforehand to get an understanding of the association and its practices. Then we look at the financial statements, because usually the financial statements are prepared by a managing agent. And then we then decide what accounts we want to look at. And it changes from year to year, depending on what happens during the year. But again, we do a lot of confirmation work. We confirm bank balances with the banks. We may send bank confirmations to the owners to confirm accounts receivable balances. If the association has a loan, we again confirm balances with the bank. We also look at a sample of the transactions that occurred throughout the year. So we look at deposits, not every deposit. We look at maybe 5% of deposits, another 5% of expenses, to see that they are properly recorded in the right period, in the right account, that's being approved by the appropriate parties, whether it's the managing agent or the board. And then we help the association really put together the financial statements and also, if need be, help them with preparing the tax returns.
Now, is typically if you have an association doing a financial statement, either cash or accrual accounting, is the audit done under the same basis, cash or accrual accounting, and the tax is the same basis, or sometimes you're doing one under cash and one under accrual? Is there any general rule on that, or I've seen it where a lot of associations may do, and they use this term, which I don't think is even a real term, modified accrual, which really, which is kind of like the standards of the AICPA has set up and how you record certain expenses, which is different. But do you see where the taxes are done one way or the audit's done one way and the financial statement's done another way, or is there an opinion about that? Or
Okay, this is my opinion, I guess from experience, most times we follow what the association wants. So if the association's preparing their financial statements on the cash basis, we will perform the audit on the cash basis. If they're accrual basis, we'll do it accrual basis. And as far as the returns are concerned, the return basis normally follows the audit. So if they're filing, if they're preparing an audited financial statements on the cash basis, the returns will be cash basis. So otherwise, then you have to do a conversion, and that sometimes can be tricky.
I don't want to get into detail on taxes, but we know there's different forms associations can elect. But the thing I think almost every association in America does every year, we call it the tax rollover resolution. And that's basically where your, the resolution itself talks about excess cash for rolling over to use in a future year. Is that something that's important for an association to do?
That's a tax question, and all I know is that it's required by the IRS code. It's a section called 7604. Yes, we make sure that we attend the board meetings for a lot of our audits. We make sure that they make that resolution.
And this is a tough question. This is the doctorate level question. When you do that resolution, and let's just say we're in 2016 at the annual meeting, are you doing it retroactively or in advance? So is the resolution on last year's expenses that we over, or is it on the next year's expenses, which are in the middle of? Do you know, or does it make a difference?
You know, that's a tax question. I think the ones that I've attended, it's a resolution for the 2017. So you're making it prospectively, not retroactively.
Yes, that's my understanding as well. That a lot of people look at these resolutions and they're going into the, they're in the year 2016.
Right.
They're really making the resolution for 2016 when they file their 2017 taxes.
Correct.
They're not doing it retroactively in the sense that you're making a statement to, as required by code, and since it's required by the IRS code, to me, you have to do this tax resolution.
Right.
If you, I know of certain issues that have come up where associations have, you get in this technical argument, they don't have a quorum for an annual meeting. So they make the decision, well, we didn't have a quorum, but we had our annual meeting, so they don't hold elections, and they don't do the IRS rollover, tax rollover resolution. And there's been proposed legislation in the past of trying to remedy that by forcing associations to have an annual meeting and not be able to use a parliamentary technicality that because they had no quorum, they really had their annual meeting, although they couldn't conduct any business, because it exposes the association to risk, because in theory, the IRS under the code could then deny their that excess cash from being tax-free or no tax, non-taxable, I guess is the word.
That whole rollover provision is tricky. We just finished an audit about 3 or 4 years ago, and one of the issues was the rollover provision. And every CPA is interpreting it a little differently, and the service has their own interpretation. So I just warn associations to be careful with the rollover provision.
And this, I don't want any specific names, but in your years of experience, have you ever seen the IRS come in and audit an association?
Yes, we just finished one.
Oh, you just finished. Did they look at the rollover provision?
Yes, they did.
Oh, okay.
And that was the issue.
And
Because we had several $1 million in rollover, and the service said that that was taxable because they didn't do the association didn't do certain things.
yeah. And I think it should be pointed out too as well that when we talk about income tax not being not taxable in association, associations should realize that we have a general excise tax here in Hawaii. There are certain revenues that are still subject to the general excise
Correct.
tax. So if, for example, they're renting out an apartment because they've done a foreclosure and they have rental income, that would be taxable with GET tax. In fact, if I'm not mistaken, the income on the interest on the earnings they make on their funds is also
Yes.
subject to GET tax.
Yes.
And so it's important that you, as an association, really look at or be aware of the tax issues. And I caution these associations with less than 20 units to make sure, again, that they adopt each year this provision that they are not going to have an audit. But the advantage of an audit is, because the small association will be probably less expensive than a large association, that they get that satisfaction to know their money is well spent. Their owners get the satisfaction to know that the money is accounted for, and then these potential issues, because usually penalties and interest are huge these days, you know, so they have that satisfaction. They know they've complied with all the IRS laws and state laws with regard to taxation.
Well, there's one more audit requirement in the statute that says, in addition to the annual financial statement audit, there's the surprise cash audit that
Right.
every association has to go through. So what happens is that what we normally do is we'll go in during the year and then knock on the association's door and say, we'd like to audit your cash for, let's say, the month of June. And that's the surprise audit. So they don't know.
And so the concept behind that, because I know that, you know, my years, I've been in this industry 25 years, I've only seen 1 or 2 cases where there's actually been some type of, when I use the word fraud, where someone misused association's money. And it's my understanding the concept behind that, it keeps them from moving money around so that, you know, when the auditor comes in, they took it from project A and put it in B, and then when B comes, they move it from C, you know, they move the money around. the cash verification really verifies the bank balances with what the book records show.
Well,
And is
yep.
that kind of a,
Well, I think that's true, but I think one of the things that happened back in the 80s when I was doing audits, they had a couple of managers, property managers, actually had only one account for all the associations that they manage. So that was kind of hard to say that this balance was the association's account. So I think part of the law required the property manager to have separate checking accounts for each association.
that's correct.
Yeah.
And actually not just checking, it'd be all the reserve funds
Right,
too.
right.
All the funds are in the name of the association and the name of that specific, and they can't commingle funds under the current statute. And I think that's pretty religious by everybody in the industry. I think everybody's pretty cautious about that specific issue. I know that sometimes one of the misunderstood things is that when a management company, for example, we have bonding and insurance. Well, we have to have some degree of control over writing the checks because our bond and insurance wouldn't step in, right? And so we have bonding and insurance, and that checking account, even though it's the name of the association, it has a real estate broker as the signatory. So the law and the bond all cover that for the association, even though in most cases the board president or treasurer are not signing the checks. There are exceptions with self-managed and things along that line. Back to the audit.
Sure.
I see this schedule that comes out, I think it's a schedule, correct me if I'm wrong, on the reserves. What is that and how much do you do with that, if any? And you know, within the audit, when you have this exhibit on reserves?
Actually, we do very little other than looking at the reasonableness of the information and if it makes, again, whether it makes sense or not. Because the reserve study is usually done by a qualified third party. And so again, we basically look at the qualifications of the third party and then read the report, and it just becomes part of the, it becomes part of the audited financial statements, but it's not subject to the audit procedures.
Yeah, and so you're not
Opining that-
validating the
no.
reserve study is accurate, and you know, I've said to many people on this particular issue is that when you look at a reserve study, you have to define all the components, and you have to define the replacement costs, and what the useful life is, and how much remaining life there is, and what inflation is going to be, and of course, the consumer price index may not be inflation on roofing material, for example. And then you have to be able to figure out the interest you're going to make on your investments. And if you could really do that accurately, you might as well be head of Federal Reserve because of the fact that there's a lot of components here.
Right.
The reserve studies are often misunderstood. They're not science, they're budgeting tools to try to give you some savings program to give you a reasonable opportunity when these costs come due, that you have a sufficient cash in the account to pay for it without a special assessment or whatever. And frankly, there's a lot of room for mistake on that because spalling, for example, concrete repair, you don't know how your building's going to weather and how well your envelope is going to be protected. And I've seen spalling estimates vary by $1 million.
Wow.
You know, so, and I don't know if anyone can solve that. And maybe the costs every year to figure that out might be huge but from your point of view, the auditor's doing very little with it.
Right. In fact, in our audit opinion, there's a paragraph that specifically states that we haven't done any work on the reserve study.
So as we wrap up the show, what is the one piece of advice you have for association board members and owners regarding financial statements and audits? And do you have any words of wisdom?
I have a couple of things. Because I used to be an association board member, and I obviously have a CPA. There are a couple of things that I'm concerned about. One has to do with the fees that associations pay. A lot of times the association is hiring the cheapest auditor, and that cheap is not always the best. The other thing is that you gotta make sure that the audit firm is licensed in Hawaii, because there's firms coming from the mainland, that they are peer reviewed, meaning that they go through a process of being reviewed by another firm. And again, to find out whether the firm that they're going to hire has any disciplinary actions against them, because oftentimes they may, if they're coming from another state, the association may not know about the CPA firm.
Well, let's summarize it. You know, the financial statements and the audit are a very, very important part of an association, and we want to thank Rodney Harano from CW Associates CPAs for being here today and sharing some of this information with us. Next week, we're going to have a detailed discussion on budgeting. and common mistakes boards make when they come up with inaccurate budgets. We want to thank you for being here today. We want to thank everybody for watching Condo Insider. Again, we're on every Thursday from 3 p.m. to 4 p.m. and aloha.